Hey, it's Friday. It is Jobs Friday. Are you excited as I am? At 8:30 on what is typically the first Friday of the month. In this case, the Bureau of Labor Statistic, the Bureau, they decided that they wanted to have it on the 8th of the month. So we had our jobs report, which is usually a market mover. And boy, did we have a missed jobs report today. 20,000 jobs were reported, and that was off by anywhere from 150 to 200,000, depending on the pundits that you see, and that video scrolling below me on CNBC. Anyway, this usually would be a great number for our bond market and mean mortgage rates would be improving. Right now we're seeing a very muted reaction. And if you look at the chart, I like to show the charts here. Remember, as bond prices go up here on the Loan Officer Hub, we always talk about technical stuff. We should know a lot of this, but just remember, as the price of bonds goes up, interest rates come down. And we've seen this nice improvement trend here. And we're in the middle of this trading range. I would have really expected this to make a run a little bit higher up towards this mark of 102.48, about a 1/4% in discount point of improvement. We do have another 4 hours in the trading day, 4 or 5 hours in the trading day. So you might actually see that happens. Just keep in mind that we have seen such an improvement off of the what were 8-year highs for interest rates, and we're revisiting where we were a year ago in interest rates. So I'm looking forward to seeing if we can actually bust through some of this, the level of what we call overhead resistance. If we can do that, we've got some room to run. We also could have some retreat factor here. We could see rates go up if they were to bust through. I just don't see that happens here in the short term. The 10-year Treasury, a lot of you guys like to watch the 10-year Treasury instead of the Fannie Mae or the mortgage-backed security market. And we're right down here on a floor of support for that 10-year Treasury. It hasn't been breached in quite a while. It did briefly in January, but if it gets through this level, boy, we haven't seen anything get that low in terms of the yields since back in January 2018. That would be good for mortgage rates. So right now, I'm just telling you, we always want to lock our rates if our clients like those things. It gets them in terms of committed and off the street. But if they are looking to shop, etc., there could be some room for improvement. And I do think that ultimately this miss in the jobs report today could ultimately lead to a little bit of improvement that we're seeing in the bond market. Hope you guys are having a great day, and we'll get you a report in the following month. Just keep in mind, it's usually the first Friday of the month, and it just happened to be an anomaly here where they picked the Bureau picked March the 8th. So next time we'll talk about the jobs report will be on April the 5th. Thanks. Have a great day.